Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at both the CFDs on gold and the SLV ETF, which is our proxy for the silver market. We have a bullish count for each and a bearish count for each. We're going to cover our Elliott wave analysis first and then some basic technical analysis before we wrap up the video. So let's start here on our bullish interpretation for gold. We have a potential trade setup here starting from below on the 29th of June. So we can see a 5-wave move up and we can see what looks like a 3-wave move back. So if you remember on the Patreon, you know how to deal with this. We use the SES, the standard trade setup. You have your 5 forward, your 3 back, then you're looking for your reaction, your entry, and then you place your stop. So potential here, so worth keeping an eye on. If you're not a member, then I would suggest, if you're not using that process, the hard stop, if you're going to use one, would have to be back here at 1750, which is the low on the 29th of June, which gives you an okay margin of error, not brilliant, 2.3%, 230 basis points. So, but still, I would say that if you are going to trade this, this would have to be a hard stop, because the length of the C is extreme already and would become obscene if it went any lower. So that's my opinion. So there you go, potential trade setup for the long side. Now, speaking of the issue I've got, A, B, C. The C here went beyond parity, went beyond the 123.6, went beyond the 1618, which gives me overall less confidence in this count being correct. That's really all I've got to say for the moment on the bullish side. We've either had a 1, 2, 1, 2 going into a 3 and we are going to explode higher, or we're going to come down, take out this low, and then the invalidation point will follow at 1676.59, and this in bullish interpretation at that point would be dead. So let's move over and have a look at our bearish count. So on the bearish count, we've accommodated 5 waves down from the high rather than an A, B, C. This gets rid of that overextension in the C and provides us with a nice simple 5-wave move into an A, potential 3-wave move zigzag into a B at a 50% retracement in our green box, which we placed a week or so ago, expecting between 38.2 and 78.6 before breaking lower to any of these highs. The white line is parity with the A at 16.67. The blue line is the 123.6 at 16.27. Did I say 2.7? I meant 6.7 back here, 2.7, and then the 1618 is 15.64. So these are the possible extensions if we completed a wave B. 5 here, 3 here, 5 here, like that. Now there is also the possibility that this is simply that same 5-wave move we observed into an A. This is a B, and the C is going to come higher like this, perhaps to the top end of the green box at the 78.6. We look for a zigzag retracement of the move down in A. We look for the B to be between 38.2 and 78.6, so we could come higher up to here. Right, that's the bearish count as I see it. Now, as you can see, like I said, if we do get that 5-wave move here, and then we get a 3-wave move here, that bullish trade setup is still valid, because you'd end up trading a wave C, a C wave. Now, as a rule, we don't like to trade corrections. Okay, we like to trade a wave 3, and that's why on the bullish count here, 1, 2, we're trying to trade a wave 3. If we're right, we're going to get very rewarded for it. If we're using our standard trade setup, we're going to be in and we're going to be out quickly with a tight stop, and it doesn't matter too much if we're wrong. But there's a second possibility of being right, which is it's not a wave 3, it's that potential wave C, in which case you can easily get your stop into profit once you see the 5-wave impulse start to develop, and protect yourself from any further loss in case it is a C, turns around and bites you on the bum. So there's no excuse for taking unnecessary risk, is the point I'm making here. You can always find a setup and a sensible place to put your stop. You don't have to take silly risks, is the point I would argue is I'm trying to make. So bullish count, these are your lower targets. There's one other option, which is this is still all corrective, but instead of being a W, X, Y, X, Z, very rare double combination, then this whole move here, rather than being a Y, X, W, is just a Y, and it's a B coming to within 90% of the A here, so a flat pattern, and then this, instead of being an A, B, C, could come a lot deeper to a 2, anyway up to 99.9%, potentially you're allowed to bring that to. It doesn't have to though, so it would be 3 wave here, this would be 3 waves, A, B, C, and then this would be 5 waves, 1, 2, 3, 4, 5. In which case you could expect even deeper move lower, because it's not 5 waves in the C of a zigzag, it's 5 waves in the C of a much greater 335 flat of a Y wave. I hope that makes sense. I promise you it does. I just know it sounds complicated. It's really not. It just sounds it. So there you go. There's your options for the bearish case. Any move back above this 50% retracement here would have me likely supporting the idea that this is a greater 535, and then any move to new highs above 1917, great movie, any high moves above that is bullish, and that the bullish interpretation was correct, and we had the fortune of setting up that wave free trade. So what you do, time will tell. I think I am, to be honest, leaning into this bearish interpretation more. I just think it looks better. I think the length of that C is just off. I'm not happy with it. Let's come over and look at silver, where we've got the same problem. Whereas gold rallied after its little bounce and continued to push into a 5-wave structure, silver broke down quite violently. We put down the 61.8% retracement here a few weeks ago. We tagged it perfectly, bounced, and then we fell through it. And we put down the 78.6 a few weeks ago, and we tagged that perfectly as well. So this is about as tight a margin as error as you're going to get. Okay, so here you go. You're within 3.8% of the invalidation point. So really now, once again, let's just assume for a moment that this is bullish, and that this is a big 1, and this is a big 2. Then, as we discussed, you can use the standard trade setup again, 5 forward, 3 back. When you're looking for your reaction, your entry, your stop, your go. And then you've got an even tighter margin of error. But, once again, this could be wrong. Why could it be? Same problem as in gold. The C of our 3-wave swing here is getting extreme. Very, very extreme. I'm using the wrong tool. Let's try that again. A, B, and almost a 2618 for the C. Now, some people are going to say Elliott never set a hard rule for the C in a zigzag or a flat. I agree. He never did. He never set a hard rule. I'm using an example on the back burner in Bitcoin at the minute. With an expanding flat pattern. It's on the back burner, it's an alternate, it's not my primary, but because of the volatility of that market, I'm willing to stretch some and to make some exceptions that you wouldn't see in other markets. Total speculation on my part, not at all anything concrete to go on other than my own personal hunch about the volatility of that market. So, like I said, and even there I'm not favouring it, I'm preferring an alternate count. So the length of this C is disturbing me. So let's come over and have a look at the bearish interpretation. Bearish interpretation on the long term is that we topped all the way back a year ago in August, well not quite a year ago, almost a year ago back in August 7th, August 10th, somewhere around there. And like gold, we've just been going sideways for a year. I know there's a lot of frustration out there with gold and silver, and people saying, oh well, it's either up or down, that's what you keep saying. Look, when you're going sideways for a fucking year, that's just how it is. You get these long drawn out sideways corrections, and the best you can do is try and interpret each internal or external swing which occurs within that broader correction. In gold there's been no external swing, in silver there has. We had this 3-wave move, we had what we're assuming is a 3-wave move into A, we had an external correction into a B beyond the previous high. This tells me expanding flat is the most likely outcome. 3, 3, looks like a leading diag into a 1, so 1, 2, A to C parity, bump, 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 into a 2, 1, 2, 3, 4, 5, down, off we go. So if this is an expanding flat, price will collapse in the coming months, probably well on into next year by the looks of it. Likely bounce in the short term though. We've had what looks like a 1, 2, 3, 4, 5. So this is likely the 1 down, that's getting close. Maybe we're going to come all the way towards this invalidation point. Then we're going to bounce into the 2. So you're going to have it, I mean really if you're a trader you've got it both ways, haven't you? You can't complain at all, because you've got 2 options here and they can both be in play almost simultaneously. Bullish count, 1, 5 up, 3 back, reaction when you get it, trade it, and off you go. And then you've got the bearish interpretation, which gives you another option: 5 down when it completes, reaction, so 5 down, 3 back, reaction, and down. So you could trade it either way at the moment and still make money, up or down. And this is the point I'm just trying to make when it comes to trading, when we talk about these trade setups, is there's no point to take stupid risks, and there's no point placing ridiculous stops when you don't have to. You could be disciplined and protect yourself, and still trade both ways when you're not certain of the broader count. The count on the smaller time frame gives you these opportunities, and the uncertainty of the longer time frame evaporates with enough time. So just take the setups as they come, place your stops sensibly, and just don't do anything stupid. Essentially, at the end of the day, is the only advice I can really give. I am favouring now the bearish count on both gold and silver because of the problems with interpreting the move down correctively. It looks impulsive. Okay, and it does to me on gold. It looks impulsive. So even if this is an A into a B into a C, or it's silver, the potential for it to break down into 5 waves, we're going to move down together by the looks of it, would be my hunch. Silver into a much deeper wave 2, gold completing a long-winded WXY or WXYXZ wave 4. The bullish counts are still possible, and the trade setups are valid for as long as they remain above your stop. So that's it, guys. That's the Elliott wave setup. So let's clear the charts now and have a look at some basic technical analysis. So we're just going to get rid of the count. We're going to come out to the weekly time frame on gold. Bring up the chart so it's nice and clear. We're going to bring up our exponential moving averages: 10 in yellow, 20 in blue, 60 in orange, 250 in green. We're going to bring up our momentum indicators. We've got an RSI set to a 10 close with a green 30 level representing oversold, red 70 level representing overbought. We have a MACD with a 10 for the short term moving average, which is our signal, and a 20 for the long term moving average, which is in orange. So what can we see here on the weekly? Above the 60, trading below the 10 and the 20, way off for 250. We got a little cross with the price here of the 10 going through the 60, but no sustained move down or price trading below it. We very quickly bounced. The 20 never crossed over the 60 on the weekly time frame, so no death cross on the weekly time frame. Could still come, and if it does here, as I've often suggested in previous videos, when you get that death cross, it's normally a sign that you're getting into the final move or nearing a bottom. And because traditional, I'm not having a go at anybody who uses them, because they can still be useful, but a lot of these traditional signals come very, very, very late in the day, bullish or bearish, and if people use them as an opportunity to enter or to exit the market, they're often very, very late when they do it. You know, probably why these kind of things are marketed at retail traders. You know, when this crosses this, do this, and it turns out it's there for a week, and then you're fucked. You know, pardon my language. You know, so that's why I don't read too much into them, is what I would say. So let's come over to the daily time frame. Oh, sorry, actually, I didn't finish here, did I? So we got the convincing move here was from the round trip here from overbought to oversold. Big bounce, impulsive looking bounce. 1-2, but then we've got the problem with the corrective nature of the ABC. Okay, is there a possibility of it being an even bigger correction? I mean, I'm just looking at it now, so could it be 5 3 deep zigzag 5 into a 2? You still haven't taken out the low, and then you go higher. Maybe we can consider that in a future video. What puts me off the idea of considering that is that silver would likely not be able to hold its lows if gold broke down like that, which would cause not a problem necessarily with gold, but it would cause a serious problem with silver. And I'm not saying they can't do separate things, it would just be a little odd if they did. So just a random thought, but let's come down to the daily time frame. Okay. Right, so sitting on the 250, that's what our support is at the moment as I speak to you. Sit on the 250-day exponential moving average. We've wicked through it 3 times in the last 4 days, and we're just sat there right now. Okay, below the 10, 20 and 60 as well. We've already had one. Okay, so here's a great example of what I was talking about earlier. You wait, you wait, you wait, you wait, you wait, you wait, you wait. 60 crosses over the 250. Oh, it's a death cross, it's the end of the world. That was the fucking bottom. Boom, off we go. So why you just can't rely on these signals, they just come so late that you would have missed pretty much all of the downward trade. So, could happen again, and then we'll likely have another flush down, but we're likely heading into that final completion, a final move. Things will get clearer in the next week or so, because we either come up, challenge this high, and we look bullish, or we break down, challenge this low. Either way, we've got our setups either way. So RSI came down from overbought to here to oversold, bounced back through neutral, not back to overbought conditions yet, just hanging around. Testing that 250 multiple times in several days suggests to me it's going to break. Doesn't have to, just suggests to me that it will. Dying bullish momentum on the histogram here, darker green bars, signal starting to roll over, ready to cross the average. It just feels like it wants to break down. Okay, so let's come over and have a look at silver, and let's bring up our 10, 20, 60, 250 exponential moving averages here. Let's back out to the weekly time frame. Alright, and what have we got here? So below the 10, below the 20, 10 crossing through the 20 with the price below it. We've got a bullish hammer at the moment for the week, and it is, well, it is Thursday. If we get some kind of sustained bounce, that's another higher low. Low, higher low, higher low. A lot of conflicting messages going on at the moment. 1, 2, 3, 4, 5. 1, 2, then 3. So yes, it could be a bullish candle. Looks like a hammer at the moment, bullish hammer, but it may signal only a temporary reversal before moving lower. Or it may be that setup that you've just got a nice 1, 2 here, 1, 2, and we're going. RSI not oversold, very typical of this sideways movement that we've been in for so long. We're not getting any significant drive down into oversold conditions. If it comes in a expanding flat pattern, it comes in the 5-wave move down in the C because everyone sees an impulse. You know, oh, it's waterfalling, it's going 5 waves down, it just keeps going lower, and that's when the panic comes, and you tend to get that. That's why you get that 1618 extension quite often in an expanding flat pattern, because everyone's just, oh my god, it's falling, and everyone just starts panicking and selling, and that could capitulate much lower. So dark red bars building up on the histogram, bearish momentum strengthening on the weekly time frame as the signal moves further from the average and starts to roll over together towards the zero bound, looking more bearish than gold has, especially over the last 2, 3, 4 weeks or so, last month or so, without a doubt looking more bearish. Let's come down to the daily time frame, and guess what we're doing? We're sat on the 250 just like we are in gold. It's the first time we've really wicked through it though. It's the first time we've put the wick, we bodied the candle above it, right, last week. Little doji here. We've bodied the candle above it, wicked through it for the first time though this whole time. Is this final support at the 250 and we're going to bounce, or is just a sign of things to come? Very positive sign on the daily, on the RSI here, with divergence between the low of the 18th of June and the low of the 20th of June. Is that right? July, Pratt. Sorry, 18th of June and 20th of July. Low, higher low, low, higher low, bullish divergence. Bullish candle on the weekly time frame, green X outside bar for this week, for today. Can we get an engulfing candle, gobble up the previous 2 sessions, close this gap? You see, from a fundamental analysis point of view here, it's actually looking like quite a solid bounce. You've got divergence, you've got a nice green bar, you've got a bullish candle, a hammer on a weekly time frame. Lots of conflicting messages at the moment. Yeah, so let's come. I think that's it, really. We'll wrap it up there, guys. I wish I could be more help, but like I said, we've been going sideways so long now. We're just doing our best to pick out each swing as we go, try and make sense of it. I am, even with the basic technical analysis here, giving some bullish support over the shorter time frame, I'm still leaning a little bearishly, purely because of how I've interpreted the Elliott wave count here. I'm open to ideas, so if you're a Patreon member and you can think of something or some alternative to explain this move outside of the ones I presented, both bullish and bearish, I'm all ears as usual. So on that note, if you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Leave us a comment in the comment section below if you want to. Thank you as always to my patrons. Your support is greatly appreciated. If you're interested in becoming a patron, there's a link in the description box below. We're getting to that point in the month now where I would honestly advise to leave it until the start of next month, because you will be charged the moment you sign up, and you will be charged on the 1st of each month thereafter. So perhaps leave it to the 1st of August to give you some extra value. Also, if you're not following me on Twitter yet, there's a link in the description below as well. Alright guys, thank you very much for joining me in this technical analysis of gold, and I'll be with you probably on the weekend now. Alright, take care guys, bye bye.